Hi, I'm Roger Montgomery from Montgomery Investment Management, and welcome to this week's Video Insight. I don't purport to know how nor when the current conflict in Ukraine will be resolved. I'm also not going to pretend to be able to divine the outlook for inflation nor economic growth. Despite these inadequacies, I do think investors should at least contemplate the implications for investment markets of both a short conflict and a more protracted one. Even before the war began, markets were processing the inevitability of accelerating increases in interest rates alongside the reality of quickening inflation. The post-pandemic surge in demand amid a supply chain unable to keep up has caused inflation rates that have most central banks now on the hop. On the one hand, investors are optimistic about rising demand for both goods and services such as travel, leisure and entertainment, and they take comfort from every reference the US central bank makes to, quote, financial stability, which of course is code for supporting equities. On the other hand, however, investors are pessimistic about the implications for valuations from an inevitable increase in interest rates and from a possible economic slowdown. Already, inflation expectations, as measured by 10-year break-even yields, are at the highest level on record. Meanwhile, a slowing economy, thanks to constrained supply of commodities and declining consumer confidence, is an increasing probability. Of course, the combination of high rates of inflation and slowing economic growth has led many to raise the prospect of stagflation and its impact on markets. Now, quite frankly, timing markets successfully and consistently is frightfully difficult, if not impossible. Jumping to cash is therefore very, very dangerous. In any case, returns from equities have proven to be superior to cash over the long term, and even during the two world wars, equity returns as measured by the Dow Jones Industrial Index were actually positive. In World War I, 8.7% a year, and World War II, about 7% a year. What an investor can do, however, instead of jumping to cash, is to tilt or shape their portfolio. For example, you might think about reducing the proportion of moonshots that are in your portfolio. They should be relatively small anyway. And you might want to increase the proportion of high quality businesses with pricing power, those businesses with inelastic demand for their goods or services, those able to pass on to consumers the higher cost of production and supply. Now, encouragingly, history also suggests some sectors fare better than others. In fact, according to recent research conducted by UBS, in past periods when inflation is high and growth slows to a moderate level, the US industries that historically outperformed the market were food staples and retailing, hygiene, healthcare and personal products, pharmaceuticals and biotechnology, food and beverages, banks, real estate and energy. Meanwhile, industries that underperformed were communication services, information technology, automotive, insurance, capital goods and utilities. Now, UBS dug a little deeper and they explored which sectors witnessed the most significant changes in returns when the economy moved from a high growth, high inflation environment, which is where we've just been, to a high inflation, low growth world. Now, UBS found that energies and materials, watch out Woodside and BHP, tech and retailing, as well as autos and consumer durables, see a sharp deterioration in returns. So-called defensive sectors such as food and beverage, pharmaceutical and financials produce the best relative returns. And if another step down in growth is experienced and stagflation becomes a reality, all sectors lose ground, including defensive. But returns in technology, energy and real estate fare the worst by far. A protracted battle in Ukraine, which appears to be most likely, could trigger sustained increases in the prices of some commodities, but more importantly, constrained supply. It's encouraging, however, to know there are some sectors that can protect and even grow in value in such an environment, and that may be just enough to prevent the mistake of rushing to the exits. That's all we've got time for this week. Look forward to talking to you again next week, and in the meantime, continue to follow us on Facebook and Twitter.